What's up guys, welcome back to the channel. This is going to be a very quick lesson. In today's lesson, I will show you how to turn a failed fair value gap to a profitable strategy. You know, a lot of people trade from fair value gaps, and that's a lot of ICT traders. They make money from trading fair value gaps. Now in this lesson, what I'm basically going to do is I'm going to show you how you can convert a failed fair value gap, just like the way we convert failed order blocks to a breaker block. So I will show you how to convert a failed fair value gap to a profitable trading strategy, and this is what we call inversion. An inversion is when a fair value gap gets closed over or disrespected. So this is what we call an inversion. Now before we can start explaining how you can make money from trading inversions, what I'm basically going to do is I'm going to explain fair value gap. But if you really want to learn about price inefficiency, that's imbalance, I will link the video in description. I've already made a lesson on that particular topic. So what I'm basically going to do is I'm going to touch on fair value gap briefly so you can be able to digest today's lesson. Now, fair value gaps or imbalance is known as price inefficiency. That is, it is created when there is inefficiency between buyers and sellers. Now, let's do this quickly. Let me show you what a fair value gap look like. Now, if you look at this, you can see if we try to mark 3 candles, because fair value gaps is just a 3 candle pattern where we see inefficiency between buyers and sellers. So in this case, you can see this very first candle, second, and this bearish candle as your third candle. What you're going to notice is that we have this inefficiency right here, this gap between these candles. So you see this particular candle came back to rebalance this. Okay, maybe this one doesn't look really clean, so let me press price forward and see if we have a very good example. Okay, so this is a nice example right here. So from here, what you can clearly see, we have this candle as our first candle, here is our second candle, and here is our third candle. Now if you look, you're going to see we have this space between these candles. So the color of the candle doesn't really matter. What matters is if you have this space. Now if you have this space, just know that this is an inefficiency between buyers and sellers. So this is what it looks like. We usually mark it like this, where we always anticipate that price is going to come back, rebalance this inefficiency, and continue to the upside. Okay, in this particular case, so the expectation, because this is what we call a fair value gap, you see a lot of people calling it IFVG. So this is it right here. We've seen this inefficiency, and if I try to play price forward, what you can clearly see is that price comes back, taps into this inefficiency. Now you see price tapping into this inefficiency. This simply means that this fair value gap has been rebalanced. Right now you're going to see a continuation. This is simply what a fair value gap means and how it can be traded. A lot of ICT traders, you're going to see them coming to take their long position right here, stop loss maybe below this candle, and you see them placing their target. This is how this strategy is being traded. So this is what a bullish fair value gap is. So in this case, you see we have another fair value gap right here. You see this bearish candle as our first candle. You can clearly see it's this bearish candle with this wick as our first candle, this bullish candle as our second candle, and the bearish candle now as our third candle. That's why I said the color of the candle doesn't matter. What we know is that we have this space between these candles. So this is what we call a fair value gap. Now how it's being traded is you're going to expect price to come to this inefficiency, and we look to trade in continuation to the upside. So this is simply what it looks like, right? And we don't expect price to always close below the 50%. Now what do you see? Price taps into this fair value gap, and you see how it's reacting to the upside, right? So this is what a fair value gap looks like. I think I should show you a bearish example before we jump straight into inversions, so you can understand what a fair value gap means, so you don't get confused when we start talking about inversion. So this is another example I showed you for a bullish example. That's for fair value gap. Now this is a bearish one. In this case, you're seeing this aggressive push to the downside. Fair value gaps are formed when we have an inefficiency between buyers and sellers. That is, it occurs when we have an aggressive movement in the market. Now you see we have this gap right here. Now the expectation is that price is going to come back, mitigate this gap, and it push to the downside. So this is how it's being traded. A lot of people might enter at the midway of this, maybe place their stop loss maybe at the wick or maybe below this zone. Depends on how you place your trades, then you can actually place your targets. Now playing this forward, what you can see, price came very close. Now you see price taps into it, and the expectation is that price is going to continue to the downside, right? That's the expectation. Now you see price comes back into the midway, taps more into the midway, but didn't close above the 50%, right? We've seen a reaction to the downside. So this is how a fair value gap is formed and how it's being traded, right? This is what a fair value gap looks like. Now what I'm basically going to do is I'm going to show you inversions, that is a failed fair value gap, how you can take advantage of that and make money in the financial market. So let's see what it looks like. Now this is the first example I'm going to use to show you inversions, and remember I said that inversions is when a fair value gap gets closed over or disrespected. Now you know we always expect that a fair value gap is going to hold price, right? Now what I'm going to do is I'm going to show you how you can take advantage of fair value gaps when it gets disrespected. Now from what you can see, we have this very large fair value gap right here, but you see price comes back, rebalances the inefficiency, and we have a continuation to the downside. And if you try to read the market structure, what you're going to see is that we have this break of structure right here, that is price pushing to the downside, right? And we equally have another break of structure right here. That is, a lot of people might not actually consider this because price didn't actually close, but let's just see that as a break of structure because price is pushing to the downside. Now we have the most recent break of structure right here. From seeing this alone, you already know that we are in a downtrend, and the expectation is that price is going to continue to push to the downside. Now if you look closely, what you're going to notice is we have this fair value gap right here, and just like the way fair value gaps are being traded, when you mark your fair value gap, the expectation is that price is going to come back to rebalance this fair value gap and a continuation to the downside. But in this case, let's see how it plays out. See, price comes into the fair value gap, and you see it breaks above the fair value gap. So when something like this happens, this is a failed fair value gap, or we can actually call it inversions, right? The fair value gap has been disrespected. This is an ICT concept. Now when this fair value gap fails, what you're going to notice is that we have a fair value gap inside a fair value gap, because from what you can see, you see we have this gap right here which actually failed. And if you look right here, you're going to see, if I try to mark it maybe with this, you're going to see we have another fair value gap right here, right? We have another fair value gap inside this fair value gap. So this is what we call an inversion. Now what you're going to do is you can look to enter from this fair value gap, maybe your stop loss below this zone, or maybe very close to this one right here, depends on your risk tolerance and how you manage your trades. Now you can actually target this sell side liquidity. Okay, this sell side liquidity can actually be your targets. Now if you play this forward, what can you actually see? What you can see is that price continues to the upside, and now we've seen what we call a shift in market structure, even though price has not yet closed above there. Okay, now you see price closed above the high. So this is what we call a shift in market structure, and this actually increase the probability of this particular setup playing out. So playing price forward right now, now you see price continues to the upside. Now we see a retracement back into this area, taps into this fair value gap, and that's your entry. And now you see price continuing to the upside. So this is actually how you can trade inversion. This is a very profitable strategy if you look to trade it. Now if I try to play price forward, what can you see? You can see that massive move to the upside after it mitigates this particular zone we have right here. Now what you see is that we have this external range liquidity at the high, and we equally have this buy side liquidity right here. Now if you look closely, what you're going to see is that we have another inversion right here where we see this fair value gap right here, and the expectation was that price is going to react from this fair value gap. Price blasts above this gap, that is disrespecting this fair value gap without respecting it. So this could be another area you could look to enter your trade. You can still enter your longs right here, maybe stop loss at these lows, then you can actually go ahead and place your targets. So this is how this is being traded. Now what do you see? Now you see how price returns and taps into the zone, and you see that push to the upside, very massive. Now after that, what do we see? Price takes this sell side liquidity, right, sweeps the sell side liquidity, reversed. We have a shift right here. You see price mitigate something. So this is how you can actually trade inversion. What I want you to pay attention is at these areas when you see a failed fair value gap, and when price blasts above that, you see another fair value gap inside this main fair value gap. This is what we call inversion. You see we have it right here where we have a fair value gap right here and right here. So that's the same thing we seen over here. We have a fair value gap right here, and we equally have a fair value gap when price disrespected this one right here. So this is inversion, and it's a very profitable strategy. So let me show you maybe one more example before I end this lesson. Now this is going to be the last example before I end this lesson. Now what you can clearly see from here is that we have been in an uptrend, and now everyone will be expecting that price is going to continue in this uptrend. And if you look closely, we have this fair value gap right here. Okay, you can see we have this pricing efficiency. Now what's your expectation? The expectation is that price is going to return back into this inefficiency, rebalances the inefficiency, that is the fair value gap, and we're going to continue to the upside. Now let's play price forward and see what we have right there. And what you can clearly see over here is that we have this inefficiency. Right now price returns, blasts below this fair value gap. It failed to respect this fair value gap. Now this is what we call what? Inversion. Like I said, this is a profitable strategy. Now what you're going to do is you're going to enter at the midway, or you enter at the zone itself, maybe placing your entry right here to take your trade, or you decide to enter at the midway. Why are you taking this trade from here? What is the confluence that's giving you the confidence to take this particular trade? Firstly, you see we have this inefficiency that failed, and this inefficiency aligns with this inefficiency right here when price blasts and move to the downside. So this is what we call an inversion. Now what you do is you place your entry. So let's assume maybe you place your entry at the 50% stop loss above the high. Then you can go ahead and place your targets depending on your trading style and how you look to approach the market. So this is simply inversion. Now if you want to learn more about inversions, you can visit ICT's channel, who is the author of this strategy. Now playing price forward, what you can see right here is now price comes back, taps into exactly at the 50% of this particular range, and now you see price reacts massively to the downside, right? So this is it about inversions, and like I said, this is a very profitable strategy which you can look to adapt and use in your trading style, right? Trading fair value gaps, it's actually profitable. These ICT concepts. Now what I can clearly see from this particular area, if I try to mark, is price comes back to rebalance the inefficiency we have right here. You see we have an inefficiency at this area, price comes back, rebalances it, and it pulls to the downside before we start seeing this treatment to the upside, right? You see price comes, respects this fair value gap. So let's assume maybe price failed to respect this fair value gap, we would have been looking to trade the inversion, right? So this is very, very simple, and you can actually look to adapt this trading style. So that's it. Thanks very much for watching this. See you by next weekend.